Okay, I think the majority of people have come into this session, and I want to welcome everyone to SEPREF's annual seminar regarding future trends in commercial real estate. Looking at the year ahead, 2024, it's already February, and hopefully it will be a more positive year than 2023. I'm Tiffany Strand. I am the chairman of the steering group for SEPREF. And as many of you know, SEPREF is a research and analysis-based organization, which is part of Samhällsbyggarna. And we focus on bringing transparency to the real estate market, and we also try to have events quarterly, and it is SEPREF who is behind the consensus that comes out every quarter, which Karin will go into. For now, I will hand it over to Jon Lekander, who is one of my fellow steering group members and the moderator of this seminar. Thank you, Jon.
Thank you. Thank you very much, Tiffany. Welcome once again to the 24th edition of the Outlook Seminar for SEPREF. We will take a slightly different tack today, focusing more on the durability of income and the risk to income for the coming year. And for that reason, we have invited Matthew Richardson from Income Analytics, based in London, who will take us through a slightly different way to look at markets. Thereafter, we will invite Karin to present the consensus forecasts, after which we will take a Q&A session. I strongly encourage you all to post your questions in the Q&A function on Zoom, and I'll pick up those questions as this is a seminar. I think that was it. I'll hand it over to you, Matthew.
Great, thanks very much, Jon. I'm just going to share my slides. Can I just check everyone can see that?
Yes.
Okay.
See the slides.
Good morning, everybody. From a surprisingly sunny UK. What we're going to do this morning, if it's okay, is as Jon's suggested there, we're going to look a little bit at the markets in the Nordic markets for the beginning of this year and the outlook, but also then have a look at how one approaches analysing markets that are fundamentally ex-growth or low growth, and approaches one can take to pricing risk and looking at sources of return. So sort of two components to this. I'm going to talk for about 25 minutes. The company itself, Income Analytics, is a London-based business, but we have offices in Amsterdam, and we have clients across the EMEA and North America, including in Sweden. And we're a specialist research outfit that looks actually at how to price risks related to real estate debt, securitization and investments. But enough about us. I always have to do the little market pitch at the beginning. What we're going to cover in this session is have a quick look at where we are in the cycle, and probably I'll leave the expert analysis of where we're going to Karin, because she's far more informed than I am, and have a look at and understand what are the drivers in the market at this point in the cycle and over the coming year or two. And then we want to sort of take a step back a little bit and say, actually, how did we get here? And what are the ways we can look at the structure of the market and those sources of return? And really begin to look at the data that we have now, because increasingly we have such good data coming from the likes of Colliers, from MSCI, from Newsec, from all sorts of people. And how can we use that information to make better investment lending and decisions, etc. And really, where are the markets going with that? And how do we apply these sorts of analyses in our day-to-day business and help us through this point in the cycle? So let's start with where we are in the market a little bit. The roots of the current problems, as we all know, really go back to 2007 and 8. We've never really got out of it. And if everyone can remember far back when I probably had hair, the problems we had coming out of 2007 and 8 were liquidity ones. The credit crunch removed money from the markets, and what we saw was a freezing up of all financial markets. And so governments introduced on the left-hand side there the concept of QE and loose fiscal policies. So in Finland and Sweden, we had a QE program where the governments effectively bought bonds to finance the markets. And all of the Nordic markets introduced low interest rate policies. The net result is on the right. So what we've got there is the chart of turnover by country from the MSCI RCA database. And the blue line is interest rates. So what we can see very quickly was if we reduce interest rates and the cost of capital, have a guess what happens to assets. Asset values balloon, and that's exactly what happened. So the point I really want to make here is we have lived through an abnormal phase in markets, not a normal one. And there's an argument that actually what we're seeing at the moment is a return to longer term trends and norms. So I think we've got to be very careful of looking backwards on these things and saying that was the norm, we need to get back there. So what we've seen, obviously, since interest rates rose quickly in 2021 is a huge impact on the property market. And the Nordic markets in particular have taken quite heavy, have carried out a heavy weight from that. And we've seen in 2023 that turnover was down quite sharply. And this really is a function of liquidity, market liquidity. So the point here is the cycle we've been through was essentially a financially engineered cycle. It was financially engineered by central banks and politicians. And I would even argue today that as we go forward, one of the key themes is we can look at demand and supply variables in the traditional way we analyze property, but actually you really need to keep your eye on the politicians and the central banks, because that's where the big decisions are going to come in the next year or two. They're going to dictate the next phase in this cycle. So financial engineering was the phrase. And really, if you think about what people were doing with property through the last 10 years, you were buying property using 0% interest largely, and you were making a very nice profit on the fact that you could borrow at virtually nothing, buy any property so long as it had a pulse and a rent running through it, and you could make yourself a nice yield gap. And that was fine. And property was also yielding very nicely over 10-year government bonds, which are its traditional measure of relative risk. And so what we saw was commercial real estate effectively become a proxy bond market, particularly for insurance and pension schemes who are in liability matching. And what we saw is investors essentially trading the gap. I mean, it was shooting fish in a barrel. Provided you had security of income on the properties, we had a market going one way because there was very little risk. And then as we saw, interest rates spiked, and then what we've seen is this reversion to the yield gap closed, and suddenly real estate looks far less attractive on a relative basis to other investment asset classes. And this is where the function of real estate being a illiquid asset becomes a problem versus the 10-year bond market. So suddenly real estate looks very, very expensive in the Nordics compared to government bonds and other markets. And when we took away that cheap money, what happened? This is the MSCI index, broken down into income v capital across all of the 4 markets in the Nordics. And what we've seen since 2021 as interest rates reversed out was capital value falls of sort of 15% plus across the market on that right-hand side there. And what's really driving that is the triple whammy, where we've got interest rates from the central banks have gone up, and we've got the withdrawal of QE programs, and obviously 10-year government bonds have become relatively attractive to property. And if you're going to hold a real asset that's illiquid versus something that's highly liquid and backed by the state and yielding roughly the same amount of money, it doesn't take a genius to work out where the money goes. And that's what we've seen as an exit from here. So property's challenge is to adjust its pricing to make itself relatively attractive again to investors versus the liquid markets. So is the correction over, or have we got further to go? Well, it depends on what you mean by the correction, I suppose, here. As this was a financially engineered boom in the first place, what we have to look at is what the policies are going to be, and therefore what happens to values and rents and yields in the markets over the coming year or two. Now, I've been rather naughty here and borrowed a very good slide from Collier's recent presentation about the markets, because actually it mirrors exactly what I think is happening in the market. So what next in the Nordic markets? Well, we go again. It's a new property cycle, okay? But what I'm not saying is that we're right at the bottom yet. The issue, I think, particularly facing a number of the Nordic markets is we've seen that correction down at 15% or so. We've seen far bigger corrections going through in the UK, in parts of Germany and the States, where we're talking about discounts to NAV in the equity markets on REITs of somewhere in the order of 30 to 35%. Now, I'm not saying that Nordic markets have to go all the way down there, because perhaps they weren't as mispriced in the first place. But it's a challenge for foreign investors to come in on yields of 4 and 5% when they can go to London, Paris, and elsewhere in bigger liquid markets and trade in at numbers beginning to start with a 6. So this is one of the challenges for the market. But I think the key point here is that we are going into a new cycle. Now, that doesn't mean values rise immediately. Typically, in a new cycle, what we see is a recovery in interest in the equity market properties, i.e. the REIT markets, and the indirect market, and in the debt market. And then over time, that's followed, as we get the corrections through in the pricing, that's followed in the direct market. And I suspect we've seen this now already kicking off in the UK, and to a lesser extent, other parts of Europe, but bits of the US as well, where we've seen very deep corrections going through. So I think what we're seeing is the first stages of a new property cycle in the Nordic markets, which we'll see coming through in the indirect market. What we'll also see is obviously the refocus in on prime, and I think that's something Karin's going to pick up. Obviously, yields reflect risk, and regional markets suffer versus CBDs and prime assets. So what we're going to generally see is probably a widening of yields in more secondary markets before they recover, and the focus for investors will be income security and perhaps lack of volatility in pricing, and therefore they will migrate first in the cycle to prime assets in the major cities. What, however, I would say, and I'll stick my neck out here, is that this is the beginning of a counter-cyclical investment opportunity. And why do I say that? Well, for the reasons that we're going to come on to, and it's this focus on income. One of the great problems in property is our fixation on price rather than yield. And the second half of this presentation is going to focus on that and suggest ways that perhaps we could adjust how we look at the markets as we move into this new cycle, because we're not going to suddenly wake up next year and everything's fine. This is going to be a bit of a tough ride for people, and particularly those who are carrying a lot of debt at the moment. So if we wrap up on the market pieces for risks, opportunities, and strategies in the Nordic markets, my expectation is we've got further falls in direct asset values while they realign to two things: relative price to the bond market, and falling away or relative pricing in other markets that are perhaps more attractive on a yield basis when markets are fundamentally ex-growth. Rates will come down, but I think I'm coming back to my point about what we've been through being the abnormal. Interest rates are not going to go back to where they were. Why? Because you don't put a fire out by throwing petrol on it. So the issue here is rates are abnormally low, which caused the problem in the first place. It's very difficult for the central banks now to adopt a policy of going all the way back to very, very low rates, because they'll simply be back in the same place in another year or two. So I suspect while we may see rates come down, what we're talking about is 25, 50 basis points rather than 100, 200 basis points in any short order. And of course, the third thing is banks' attitudes to refinancing have changed pretty rapidly for anyone who's been working in the debt market over the last couple of years or talking to lenders. So the risks are, when you're going in at the moment, you're catching a falling knife. Prices are still falling, That's usually the point in the cycle actually where you've got more distressed sellers in the market and more people, there's a lot of opportunity around both on the debt side and the equity side. So what are the opportunities? Real estate debt acquisition via debt restructuring is obviously a very interesting angle, that one has to understand the structure of the debt that's attached to the properties and the underlying value on that. It's an area we've seen a great deal of activity in the UK markets and in the US markets recently. And as you all know, the private equity companies are now very active again and have been raising money for just these strategies across EMEA. And that money will be available in the Nordic markets. And it's going to be very interesting, I suspect, particularly in the Swedish market, where we probably have a slightly bigger problem in terms of the structure of the debt and the levels of debt applied to the markets and the level of correction. The second thing at this point in the cycle will be merger and acquisitions in the indirect market. And this is REITs going private or being acquired by each other. And again, where we're looking further ahead, I'll take again, apologies for the reference to the London market, but we've seen a host of M&A activity. Only this week, Tritax, one of the largest logistics companies, going through a merger. We've seen London and Metric acquiring LXI. There's a lot of REITs going either private or merging quickly. And why? It's because the equity market has priced in the fall in values far more aggressively than the value as the appraisers have. So while on the MSCI we've seen a 15% fall, on some of the indirects, the pricing is now down in the 20s. So obviously there's an opportunity to buy the equity with the price of the value, the values of the income, values of the property rather, baked into the deal. So equity is a very neat way of acquiring discounted assets at the moment. And that's that last point there with delistings. There will be a series of people also delisting and taking private, because it perhaps doesn't make a lot of sense with the discounts being applied to be in the market at the moment. So if we're looking at a market that's fundamentally close to the bottom, and we've still got a bit more pain to go, but on the turn, the strategies in those markets really revolve around 2 or 3 things. And this is always has been the same way, and I'm old enough to have been through 2 or 3 cycles. The first thing that everyone begins to focus in on is income security. Okay. What's the quality of the tenant and the risks to default on the underlying cash flows? And what's the duration of income? What certainty have I got on that quality income for my hold period, for my investment or my loan? And then the second part is active management of assets. So in an ex-growth market, active management, rather than just collecting the rent, becomes a very big part of everybody's day job as an owner or an investor in property, or working with your managers to actively sweat assets rather than simply collect the rent. So what we're going to do now is shift over and really focus in on this income security and duration piece, because actually it's largely ignored. And I want to just touch on a few points that actually have been universal all the way before this cycle. And we should really, as an industry, take a step back and look at. Okay. And what we're going to focus in on here is, as the markets, as I said, transition, what we're really seeing is the role of real estate becoming more bond-like in the Nordic markets, i.e. the focus becomes far more on its ability to generate income than capital growth. So I really want to restate the importance of income in a deal, okay? Because commercial real estate investment is fundamentally about cash flow. And that's a really important statement. It's fundamentally about cash flow. Even developers are selling the ability to generate future cash flow. And it's the cash flow that pays everybody's fees, the equity dividends, the fund distributions, the debt cover, the securitization payments, yeah? And in the absence of capital growth, i.e. the market we're in at the moment, the commercial real estate effectively is going to behave more like a bond, i.e. its focus is on delivering on income return. And what I want to show you in a moment is when you look at the structure of long-term returns from the Nordic markets, 75% of the total return over the last 10, 20 years comes from your cash flow. It doesn't come from your capital values. So the value of real estate is ultimately determined by the level and duration of your rental income, okay? And what I really think we need to do at this point in the cycle is drop the fixation with valuation and have a look at the structure of income and what can we actively do to manage this. Let's have a look at the actual numbers on the Nordic market, okay? It's always been about income. There's a couple of interesting charts here. If we take that MSCI index, the total return quarterly index over the last sort of 10, 20 years, its properties delivered around 7% per annum. And of that, 5.3% or 75% of the return has come from the income. And if we move to the right and look at the volatility attached to that, that income has been highly recurring and structured. What we're seeing is in any 1 year, the income return only, the volatility is only 1.4%. Look at the corresponding numbers for capital values. Capital value growth over the last 15, 20 years has been 1.6% with a volatility of nearly 7% on it. The point I'm trying to make here is income has always been the driver in the market and should be the thing that as investors we focus on far more in our underwriting and our week-to-week management of assets. And this is very, very important because this is the maths. 3/4 of your return is going to come from your income. And look at the if we do the maths on the probabilities, chasing capital growth and buying markets in and out of capital growth is very, very difficult because of the volatilities attached to it. As investors, we can control the income by restructuring it, by working with people, by replacing tenants, by restructuring leases or actively managing assets. And this is what we really need to be focusing on now, because the figures for the next year or two are going to be pretty much 100% income. And so at the bottom there, I've said, this is a behavioral problem we have as an industry. We constantly anchor on capital returns when real estate is not about capital returns and never has been. It's the income component that drives the capital, and that's what we should never lose focus of. And let's take that a step further and think about what a lease is. Okay, a lease is effectively half of the investment. If we think about what real estate is, real estate's a hybrid asset class. It's got an equity piece which is the value, and it's got a debt component, which is the lease. And if we think about what a lease, how the structure of a lease is a duration risk to a counterparty over a term in return for a payment. A lease is a bond, and it should be valued as a bond. And in your analysis and your underwriting, particularly for the next year or two, we really need to be focusing on what's the risk to the income and what's the risk forward to the income. And this is really important because as our market changes and we become part of financial markets, we need to be far more sophisticated in how we communicate this to our investors. Because we've seen where our performance comes from, we need to be more sophisticated in that analysis and how we pull that together. So if we work with the concept that the lease is a bond, how do we analyze bonds? Well, we can go to the bond market and find out for that. And the bond market guys have been doing lease analysis or income analysis for donkey's years because we value bonds very simply. We look at the quality of the borrower, in our case, the tenant who's borrowing the space, and the duration risk of the bond, in our case, the lease term. And we work out a value based on how good the tenant is times the lease length that we're taking. It's not rocket science. So we need to be thinking about leases as bonds, particularly at this point in the market, and valuing them in that way. So how does one do that? And how does one apply it? Well, I want to introduce you to something of concept, something called probabilities of default, or PD rates, which are widely used in the bond space. Probabilities of default are numbers attached to the probability that a tenant will fail or a company will fail and therefore be unable to meet its obligations. Now, we all do this a little bit when we're looking at in our underwriting, and we typically download company credit reports or similar. And we look at credit ratings from the likes of people like Equifax or Dun & Bradstreet or credit reform or whoever it happens to be. And when we're making real estate investment or lending decisions, what we tend to focus on are credit ratings of companies. And credit ratings of companies are subjective ratings, typically. They usually say something like low or high risk, which is utterly useless in any form of analysis because it's not quantitative. It doesn't tell us what probability I'm applying to that future loss, okay? And the other second thing that we tend to do as an industry is emphasize P&L and balance sheet items in our decision. This company is big, it has a turnover of 2.6 billion, therefore it must be a good tenant. Nobody bothered to look that that tenant is WeWork, so you wouldn't sign a lease with them. The point I'm really making here, as an industry, what we should be focusing on, and you can get this from all of the people that you work with if you use company credit reports, don't use credit ratings, look at failure scores, okay? Look at probabilities of failure, which are usually provided as a percentage on these things. They're a far better way of looking at how and when companies are likely to miss paying you your rent, okay? And the second thing is do not focus on P&L and balance sheet items. They're not good at spotting future problems. When you're working with your tenants, the sorts of things that you need to be looking at are multi-factor indicators. When you look back at the history of failures of companies in different markets, what you can see is the companies that fail have certain behaviors, and they're different in different markets and different sizes of companies. But typical things that you want to look out for are not P&L and balance sheet items. The most dangerous thing is late filing of accounts. That's highly correlated to companies failing within 12 months. Age of company. Companies under 3 years old in Sweden fail 50% of the time. It's just a fact. Look at payment patterns. How are they paying their suppliers and bills? These are the sorts of things that as active property managers in an income-only market, we need to be focused on, okay? And the key thing as well is who is the counterparty? Do I actually understand the person I'm taking the risk to? What's their business model? And how comfortable am I having a 3-year or a 5-year or a 10-year lease to these guys, okay? And so what I'm saying is move away from credit ratings. Do not rely on credit ratings. Look and talk to your suppliers about getting failure scores and default ratings out of them as you go through this process. And I'm not going to talk through this, but the point I wanted to make here is how do we calculate PD rates? One looks in property by looking at actual failure data, not credit ratings. So you can go through all of the failures in Sweden or Norway or Denmark or Finland, and you can look at the various things that were in play historically when certain types of companies failed. And that may be changes in management, it may be change in payment patterns, it might be late filings, it could be accounts, it could be adverse news, it could be all sorts of things. But be aware to the fact that you're going to get hit from lots of different directions. So do not rely on that narrow thing of looking at company accounts. Company accounts are not a good way of individually assessing corporate risk on the cash flow. Okay, so what can we do with probabilities of failure? If we can calculate the percentage probability of failure based on what's historically actually happened in a country, we can do all sorts of things, because it's essentially what we're able to do is replicate what the bond market does. We can forecast that, we can look forward and say, well, typically, if a company's risk profile looks like X today, historically, it fails with this likely probability over 1, 2, 3, 4, 5 years. And we can begin to use that in our modeling, okay? And by doing this, it allows us to do a couple of interesting things, which will also help us at this point in the cycle. It allows us to standardize understanding of risk across borders, because we're using numbers, and a lot of the tenants in our buildings are likely to be owned by subsidiaries of foreign companies, or they're likely to be linked to foreign companies, and we need to understand the relationships there. But what I'd urge you all to do is, if you are looking at income, and it is the most important part of the equation, focus on actual failure data, work with your suppliers on that, and apply these to your cash flows as actual quantitative analysis in your DCF modeling if you're an appraiser, or if you're a letting agent in how you adjust your rent to reflect the risk of the tenant, or as an investor, how you adjust your cap rate to allow for the probabilities of loss during that hold period. How accurate are these sorts of things? I just put one in. The top line there is Sweden. Unfortunately, I didn't have one for Denmark. But predictive rates actually are in the market are pretty good. I'd be happy to share these afterwards. Essentially, if you do model failure data and you look back at it, spotting problems is pretty good. And for companies that already score very well, what you'll see from the curve there is the probability that they fail is absolutely minuscule, which doesn't necessarily be a big shock. But obviously, what we should be doing is reflecting the scale of risk between having a government tenant and a struggling tenant in our cap rate far more effectively. But I won't jump into that in the interest of time. So very quickly, what can we do with things like that? Well, we can apply scores to leases, PD rates to leases. So if I'm signing this is an example of looking at Nordic Nest, it's a retail. What we can say is, based on the current risk profile, signing a 5-year lease with them carries a certain probability of default. It allows us to benchmark the relative risk we're taking with that cash flow. It allows us to map it to the bond market and say, what's the quality of this income versus bonds? Because if you remember at the beginning, what's driven this cycle, our relative risk to bonds. Okay, so we can begin to compare the risks that we're taking and explain that to our investors and say, this is the quality of what you're buying from my portfolio. We can group up analytics and we can look at buildings and say, okay, at a building level, as an appraiser, valuer, what kind of adjustment should I be making to the cap rate to allow for the quality of the cash flows and incomes? What's the bond rating? What's the income stack if I'm talking to the lender, and communicating that risk both operationally and again to the investor or the client. And finally, I can do that at a portfolio level for a loan book or a CMBS or anything else. The point I'm trying to make here is be quantitative, be structured in how you put this data together and how you price it, because it's going to be very, very important over the next 2 years if you're trying to access capital, that you can communicate the quality and strength of that cash flow, how it's going to be capitalized, and what returns and what probability of that return can be given to the investor or the lender. It's going to come down to numbers. The world is changing. And of course, we can apply these throughout our business, because whether we're in letting, in valuation, property management, we should be using this type of analytics throughout our businesses so we all understand what we're doing day to day in our different teams as we work with one another, and exchange information about those cash flows and about those tenants and how we use that information. And really, I wanted to finish up with the growing importance of focusing on the analysis of income. The Nordic markets are now part of global institutional asset classes. Real estate is a global institutional asset class alongside equity and debt. There's a greater demand for transparency. We've got regulators, compliance, and investors all demanding more information. Okay, they want to know about future performance. We've got a world that's demanding more and more income, and real estate plays a big role in delivering that income for pensions and insurance. We've got demands from appraisers and from regulators on greater analytics and best practice. And what we're seeing is the Nordic markets becoming part of the globalization, financialization of commercial real estate at the top end. And this is very important because financial markets run on data. And if we want to capture a bigger slice of the money allocated from the top, from the algorithms, we need to get our house in order with how we price our risks, how we provide that information, and how we compare ourselves with other asset classes, because the investors are looking at they're walking into a candy store and they're choosing different things, and we have to be attractive and on that shelf for them. So conclusions. What we've really been talking about today is all of the markets have reached a point where we're now at inflection point. That doesn't mean we're going to see massive valuation growth. It means we're now in a period of active management. But what it does mean is that it's a very attractive time to be looking at commercial real estate. Why? Let's go back to those slides. If 75% of your return comes from your income, you buy in income-rich markets and you sell into value markets, yeah? That's how you maximize your returns. We're just going into a new phase of income markets. The yields are very, very attractive and are going to get more attractive if you do your homework, okay? So it's great to focus on income quality going into this cycle. Use your quants and your analysis doing this stuff. It's not good enough anymore to simply look up or phone somebody, look at something. If you think about what you're doing, you're signing a bond agreement with your tenant. Have the drains up on that organization, understand what they're doing. Let's get more sophisticated. Don't think about your risk today. The risk that you're taking when you sign a lease, look at a valuation, is a future risk. The investor is buying a future risk, the certainty that that rent will be paid and paid back to them in the form of a dividend or a distribution, yeah? And that's why you need to be forward-looking when you start analyzing these cash flows, okay? And really what this is about is a lot more focus on the G in ESG. We're all doing a lot on the E, but this is about good governance. It's about understanding the risks we're taking and communicating them to people and putting a price on the decisions we make as investors going into this new point in the cycle. And I leave you with a very interesting thought. I did a bit of research on the SEPREF database of global markets. The value of the 4 markets in the Nordics is about $785 billion. If we applied 35% leverage to that market, that's a debt market potential of about $275 billion US of debt. And the value of the listed market is about $65 billion. What underwrites all those 3 numbers? It's the 39 billion of rent that's paid by tenants. It's 39 billion of unresearched, unrated cash flows hitting balance sheets. Now, if I was being very facetious, I could say, what could possibly go wrong? But I'm not going to say that, because I think as an industry, we are changing, we are becoming more sophisticated. But just think about the scale of these numbers and how as an industry now, we probably need to adapt and begin to become a little more nuanced on how we underwrite, how we value, how we invest and how we lend, because the numbers involved in these markets are very, very big indeed. But thanks very much for your time. I'm going to pass you back to Jon, if that's okay.
Thank you very much, Matthew. Very interesting presentation. I have a number of questions, but I'll, before we come to those, and hopefully we'll get some more questions from the audience as well, I'll hand over to Karin. Take it away, Karin.
Thank you. I'm now gonna share my screen. Okay. Yes. I'm going to take you through our consensus forecast that we are doing in SEPREF. This is a presentation that I put together this weekend, so all the numbers are very new and fresh. We haven't released them before this event, but I'm going to start with giving you some information about this survey, how it's done and so on. So we started this survey back in 2008 in Stockholm as a trial thing, and it went well. So then we added on Gothenburg and Malmö 2 years later. And this survey focused on office, prime office. And we send the questionnaire to quite a big piece of the industry, real estate consultants, institutions, listed and unlisted property companies, and investment managers. And we ask them basically 2 sets of questions. The first one is a short-term forecast. Like, what do you think is the prime office yield and prime office rent in Gothenburg, Stockholm, and Malmö by the end of the quarter? So it's a really short-term forecast. It's less than a quarter. But then we have another set of questions, and that's a little bit longer. It's the 12 months trend for yields and rents. So is the rent and yields increasing, declining, or will it stay unchanged over the next year? So it's a really simple survey. And I would say that's like the beauty of it, because it doesn't take long to fill out the questionnaire, and it doesn't take long to get the results. And therefore, we have been able to do this survey for such a long time. And the overall purpose of this survey is to improve the property market transparency in Sweden, to make the market a little bit more sophisticated in terms of data.
Karin?
Yes.
Are you going to share your screen as well?
Am I not sharing my screen?
No, you're not.
Oh, God. Sorry. I'm going to try again now. Screen 2. Share.
There we go.
Yeah, 2 seconds.
That's your background. That's
Yeah,
your background.
I know.
Yeah.
So I'm going back. Yes. This is what I'm. Oh. Sorry, that was the first. I'm sorry for making this mess. This is what I just gone through about the survey, and this is the latest results. So at the top of this slide, you can see the latest results in the short-term forecast. That's a green field. You see yield rents for Stockholm, Gothenburg, and Malmö. And if you go to the bottom, you see the previous survey results. So you can compare what's happened over the last quarter. And then we have the trend. And for example, it says if you look at Stockholm yield 41%, that means that 41% of the respondents believe that yields will increase in Stockholm. So that's how you interpret this. But I've made some charts and graphs to illustrate this a bit clearer. This is the short-term forecast for Stockholm. So it's a series of forecasts, but because it's such a short-term forecast, you can use this as the actual values. But what is it showing? You have the rent in black and yield in orange. So you have the rents on the left-hand scale and yields on the right-hand scale. And we can see that in the last survey, the Stockholm prime rents, the forecast has increased quite a lot. It's now up at 8,800 kronor per square meter, which is quite high by Swedish standard. I think if this was showing the secondary side of things, you wouldn't see this development. We have a strong flight to quality trend in Sweden as in other markets. So that is really pushing up the rents. And if we turn to the yields, you can see a very sharp yield movement starting back in mid-2022, and it's moved out by 90 basis points to current value at 4. This slide shows the 1-year forecasts. You have the circle or pie chart up to the left. That's the distribution of responses for Stockholm. And what it says is that 53% of the respondents thinks that rents will remain unchanged over the next year. And 29% think that rents will decline, and 18% thinks that rents will rise. And the chart below shows the distribution between those who expect rents to decline and to rise over a longer period. So you can see how this is changing over the cycle. And I think that's perhaps the most interesting chart in this presentation. So it's still more respondents who thinks that yields will fall than to rise over the next year. But the majority thinks that rents will remain unchanged in Stockholm. And if we turn to the right-hand pie chart at the top, that's the yields. If you look at the chart below, you can see that over the last 1.5 years or so, there's been a big majority that has voted for yields to increase. But in the latest survey, it's a little bit more balanced view. So there is a certain a percentage, 18%, who thinks that yield could start to decline over the next year. And that's really what many are waiting for yields to show some sort of stabilization. So let's move on to Gothenburg. Gothenburg is a more stable market than Stockholm, but Gothenburg has seen rents increase. I think that has to do with this flight to quality trend, and also lots of new, modern, attractive offices coming out in central locations. So that is pushing up rents up to current value at 4,000, which is record high for Gothenburg. But we should remember that this is a forecast, a short-term forecast. But if we look at the yield movement, yield started to move out 1 or 2 quarters later in Gothenburg compared to Stockholm, but the outward movement has been just as strong. And if we look at the 1-year trend, there is, in the latest survey, there were no one of the respondents who believe that rents in Gothenburg will increase over the next year. There's a big supply pipeline that I think is holding the rent expectations down. 61% believes that rents will be stable and 39% that they will be declining. And yield is showing pretty much the same spread of responses as in Stockholm. So it's a small share, 11%, who thinks that yield could start to come in. And the final market, that is Malmö, is also a stable market in terms of rental growth, because a same story as for Gothenburg, but it started earlier. A big supply pipeline, completely new sub-markets have been built. But there is a certain upward movement in rents in Malmö, in the prime, very, very prime locations. And here you can see the yields have moved out the most in Malmö compared to Stockholm and Gothenburg, 100 basis points. And if we look at the 1-year expectations, no much room for rental growth, so to say, or no much expectations for rents to rise. And yields, it's basically the same distribution as for the other markets. So that was my final slide. I'm sorry for my problem with my presentation in the beginning. Thank you very much for listening, and thank you all who participate to this survey. It's great that you are responding every quarter and have been doing that for so many years.
Thank you very much, Karin. Thank you both for your presentations. I have a couple of questions that have popped up here. One is on distress. There's a bit of a rumbling in the US with regards to both defaults on debts, as well as the potential impacts that can have on the financial systems, in particular when it comes to regional banks. Have any of you seen similar patterns in Europe or here in the Nordics?
Do you want me to start, or
yeah,
Karin? Or okay,
please, Matthew.
Not in exactly the same way. No, I mean, I think it's been interesting, because I know probably you're referring to some of the CMBS failures that happened on the West Coast at the end of last year, and obviously we had the one in Finland. Generally speaking, I think he says something very foolish here and touches wood while he says it. The banking sector in most places has been a bit more sensible this time around than it was last time, and I think that's a feature of the regulators being a lot harsher on the banks than they were in terms of, you know, calling the banks in quite a while ago and giving them a talking to and saying, listen, we know there's an issue coming here. The US banking sector is quite a strange one because it's a very different structure to the European banks, in the sense that you have the New York banks and you have the investment banks, and then the regional banks are very regional. And the regional banks have effectively taken on an awful lot of high risk cash flow income, and to some extent it's a lot of the stuff that was in the bonds that blew up in 2007-8. So I don't think that problem is necessarily going to be replicated over here in Europe. What I would say, though, is somebody owns that debt. And what we have had is the emergence of a lot of parallel lenders, either via funds or a lot of Asian money that's come in and acted as debt. And what we don't yet know is how much of, or in the case of equity as well, how much of that is actually debt back in China or other places. And how that will unwind now things are happening there. So I would say, generally speaking, I don't think we're going to have a rerun of 2007-8 because of changes that have been made by the regulators, and the banks themselves have generally been a bit more sensible. But we are still having a debt crisis, because we always have a debt crisis in property. You know, it wouldn't be property without one. The issue this time is, I think the number of lenders is far wider, so therefore the risk has been spread across the financial markets. But I would still question that there are going to be problems coming to the surface about some of the sources of that debt capital going further down the line. And I think the big issue for everyone on here is, I think that's going to be, in a sense, the trigger that tells us when we're at the bottom of the cycle. What we're waiting for at the moment is the refinancing wall, which I know is particularly big in Sweden coming through. And it's how the lenders react to that. If the lenders call the debts and we see fire sales, then we will see some quite aggressive markdowns on some of the market. If the lenders are prepared to restructure and work with the borrowers, we may well have a gliding landing, and therefore not that much more adjustment in the cap rates. But as I said, it could, if we see fire sales, we could see cap rates push out quite aggressively in parts of the market.
Karin, any thoughts on your side?
Not really. It's nothing I have seen so far. I don't think we will have a repetition of what we saw 2008, 2009. But who knows?
Yeah, it's always scary, right? When you don't know where the debt lies. One thing that sets in particular Sweden, I believe Finland, apart from the rest of Europe, is that the leases tend to be relatively short. Is that anything that impacts your view of the markets from sort of the outside in, Matthew?
Not really. I mean, it's you know, people still buy and trade short bonds and they still analyze them even though they're short. I come back to my good governance point. We could argue, what's the point in any sort of analysis on a 3-year roll? But, you know, you're still selling a product, and it's incumbent upon you, and a fiduciary responsibility really, to understand the risk you're selling to someone. And it's also a correspondent risk, responsibility on the investor to understand the risks they're taking. So it's really, what we're talking about is an approach to just put numbers on things rather than labels. Having said that, it does make for a slightly different shape in terms of the way the cash flows fall in a lot of the Nordic markets because of the short leases. Having said that, the lease structures are coming in all over the place. I mean, when I first started in my career in the late 80s, leases were sometimes 25 years in the UK. I think the average lease length's now down to about 8.5, 9 years. So I think there's a convergence. I think it's still important that we spend time looking at this stuff and being the best that we can be in our underwriting and how we work with pricing risks, because that's essentially what we're selling to people.
So we're approaching something that might be the bottom of the cycle, which raises some questions. The question if interest rates are not moving down to zero again, are we going to see the same amplitude, or are there other sort of aspects of the coming cycle that we can discern already at this stage? Karin, do you have any thoughts on that? Or
Well, I don't think we will go back to having this like money for free, zero interest rate. I think the last 10 years has been not normal, not sustainable. If you've been in the industry for some cycles, I think it's would be healthy to if the market went back to a more like normal situation where interest rate is not zero and their focus is on both the income side and the capital value side. So I think it's I think we will see a more back to normality, or I hope so anyway.
I'd echo that, Karin. I think you're right. It's as I said in the talk, you know, the problem has been caused in terms of asset values inflating to ridiculous levels, not because there was necessarily an inherent value at having cap rates at 3% on logistics. It was simply because you could still make money at 3% on logistics. It was moral hazard. We were, you know, the old story of the frog and the scorpion. In the end, people are scorpions. They will push the risk to the limit until it goes bang, and it has. So, but I agree with Karin's point. I think the policymakers know that that's what caused the problem, and you don't solve the problem by reintroducing more liquidity to the market. In a sense, what we're doing at the moment is beginning to squeeze that liquidity out till we get to a more balanced market that's perhaps driven by more fundamental demand supply factors in the property market rather than the price of capital.
Yeah. And I think, I mean, we've seen QE, but we've also seen the starting point of QT, sort of tightening of liquidity from the central banks. Is that going to go all the way to zero, or would that upset the whole system?
Ooh, now you're asking a big one.
All right, so we'll switch on.
Well, no, the other thing to make, well, I would say one comment on all of this. I think there's always a sort of slight misapprehension that QE and zero interest rates was somehow free money. It wasn't. All that debt is still there. It's just on the balance sheet and the taxpayers covering it. So it was never free. It was a transfer of wealth from the tax base to the private sector, and at some point it has to be repaid. And so I think, you know, that's a key point to make. And I think the banks and the regulators are looking at that as well, because you don't want a flood of that stuff coming back into the market. You know, because if we had a sudden flood of QE bonds hitting the market, that's also going to hit property values. So there's a very delicate balance for the next few years in how they begin to pay this stuff down.
Yeah. Another thing which has been sort of spoken about a lot has been work from home, and sort of the secular trend of we're not going back to the office full time. We're going to spend more time working from home, etc. Is that a secular trend that sort of changes the demand for, in particular, office space, or is that possible to handle within the current sort of current market? Karin, do you have any thoughts?
Well, it's a tricky question. I don't think that we will go back to every day 9 to 5 in the office. I think flexibility is here to stay, but still there is a need for the office, but the office has to be something more. It has to be better. You need to be more in order to go to the office. You need to be more productive, or to have some sort of like big benefits to be there. So I think it's offices has to like step up the ladder to be competitive in the future. I don't think office is dead by any means, but I think the office has to be kind of in a different shape, so to say. I don't know exactly what it would look like, but I think it's we will have to put more effort into the office, and also into the whole like leadership issues. I don't know if that was an answer to your question.
It definitely was. Matthew, any thoughts on work from home?
Yeah, I mean, I think, I mean, I can give a particular UK-based thing because it's been it's had a massive impact here. I think it was Collier's published a piece of research recently showing different markets around the world, and places like Japan and I think had gone back pretty much to offices. We're certainly not seeing it here. And I think there is a fundamental change. Having said that, I'd agree with Karin's observation that the nature of the office itself is changing. It's becoming more of a space where slightly different things happen rather than just cramming in as many people as we can. Because I think, you know, we have to take a step back and remember that real estate values are a function of people performing economic activities in a place. And you know, the more profitable the activity, the more centered, you know, close to the CBD they are. That's how the market works. And in a sense, some of those things don't require you being in. In fact, a lot of the financial services don't require you being in the same way. But what we're certainly noticing is that the nature and use of the office space itself is changing. Densities have gone down. And it doesn't so far seem at the prime end to have hit rents in the same way. I know the US one has been slightly different, where they've had quite big problems with, you know, overspace effectively in Manhattan, with people just not coming back to the office at all. And that has caused some impacts on rents there. But I don't know, at the top end, we've not seen it. I suspect it's going to have some impact on values. And as always, it will probably asymmetrically hit the secondary market, because the big employers here, I've noticed the likes of the big banks and the accountancy firms and the lawyers are demanding that people come back into the office now.
But I guess over time, the risk is that the willingness to pay for office space declines.
Yeah, and the nature of it changes. I mean, we're seeing still the extension of flexible working. You know, it's a different model, isn't it? It's very difficult to quantify because, you know, none of us would have predicted quite how the convergence of technology and COVID caused this. It's very difficult to understand where it goes next. But what we do know is that human beings fundamentally like to be talking to each other at some point in the week, and I'm based on my own work. We ask our guys to come in on a fixed number of days a week, not least because the youngest people need the experience of sitting alongside and working with more experienced people and learning the trade.
Okay, Tiffany, do you have any additional questions or thoughts? Nope. Okay, then I think we will wrap up here. Thank you both for your time. A very interesting discussion and once again very interesting presentations. And thank you very much for your time on behalf of SEPREF.
Great, so thanks very much for having us.
Thank you.